For over a century, oil has been more than just a commodity. It's been the bedrock of modern civilization, powering industries, transportation, and global economies. The Organization of the Petroleum Exporting Countries, OPEC, formed in 1960 and later evolving into OPEC+, has become a central player in this story, wielding considerable influence over global oil supply and prices. Understanding OPEC+ history and its impact is crucial to grasp the significance of their latest decision to increase oil production. OPEC's formation was a watershed moment, as major oil-producing nations sought to assert control over their resources and challenge the dominance of Western oil companies. The 1970s oil crises dramatically demonstrated OPEC's power, with embargoes and production cuts sending prices soaring and triggering global economic instability. This era cemented OPEC's role as a key manager of global oil supply, a position it has held for decades. More recently, the rise of U.S. shale oil and other non-OPEC production presented new challenges. In response, OPEC joined forces with Russia and other producers to form OPEC+, creating an even more powerful alliance capable of influencing global oil markets. OPEC+ demonstrated its strength in 2020 during the COVID-19 pandemic, implementing unprecedented production cuts to avert a price collapse amid plummeting demand. The global economic context leading up to OPEC+'s current decision is characterized by significant uncertainty. Inflation remains elevated in many parts of the world, despite central banks raising interest rates. Global economic growth forecasts are being revised downwards, with concerns about potential recession in major economies. Geopolitical tensions, particularly the conflict in Ukraine and broader instability in the Middle East, continue to inject volatility into energy markets and the global economy. These factors have created a complex set of pressures on OPEC+. Consumer nations are urging increased production to lower energy prices and ease inflationary pressures. Simultaneously, OPEC+ member states must consider their own economic needs and the desire to maintain stable oil revenues. Oil remains fundamentally important to the global economy. It fuels the vast majority of transportation, powers industries, and is a critical raw material for numerous products. Energy costs, heavily influenced by oil prices, are a major driver of inflation and impact nearly every sector of the economy, from manufacturing and agriculture to transportation and consumer goods. Access to affordable and reliable oil supplies is essential for global economic stability and development. Even as the world seeks to transition to cleaner energy sources, oil will continue to play a significant role in the global energy mix for decades to come. Therefore, OPEC+ decisions regarding oil production have far-reaching consequences for the global economy, impacting inflation, economic growth, and the pace of the energy transition. Their latest move to gradually increase output is a significant development that warrants careful analysis. The OPEC+ agreement to increase oil production by 2.2 million barrels per day is a carefully structured plan, implemented gradually to minimize market disruption. This isn't a sudden surge, but a phased approach unfolding over 18 months, starting April 1, 2025. The incremental nature of this increase is key to understanding its potential impact and OPEC+ strategic intent. While the precise schedule of increases is not public, a likely scenario involves phased boosts every few months. Imagine initial increments of 200,000 to 300,000 barrels per day, gradually scaling up over the 18-month period to reach the full 2.2 million barrels per day target. This measured approach allows the market to absorb the additional supply progressively, preventing a sudden price crash and giving both producers and consumers time to adjust. It reflects OPEC+'s aim to fine-tune supply in response to anticipated demand growth, rather than overwhelming the market. The 2.2 million barrels will be contributed by key OPEC+ nations, with Saudi Arabia and Russia expected to take the lead. Saudi Arabia, as the largest producer, might contribute around 800,000 to 900,000 barrels per day. Russia, the most significant non-OPEC partner, could add 500,000 to 600,000 barrels per day. The UAE and Kuwait, with substantial capacity, might each contribute 200,000 to 300,000 barrels per day. Iraq, Algeria, Kazakhstan, and Oman would likely contribute smaller volumes. These are estimated allocations, as OPEC+ hasn't released a detailed country-by-country breakdown, but they represent a plausible distribution based on production capacity and historical trends. This production decision is the result of complex internal negotiations within OPEC+, driven by a mix of factors. External pressure from major consumer nations, concerned about high energy prices fueling inflation, played a significant role. The US and other major economies have repeatedly called for increased output. Internally, OPEC Plus members face diverse economic realities. Some nations, with robust economies and lower production costs, may be more comfortable with slightly lower prices in exchange for increased market share. Others, more reliant on high oil revenues for their budgets, might have preferred continued production restraint. The 2.2 million barrels per day increase likely represents a compromise, balancing these competing interests and attempting to navigate a complex global economic landscape. Finally, the type of crude oil added to the market matters. OPEC Plus nations produce various grades, from light, sweet crude, ideal for gasoline, to heavier, sour crude, better suited for other products. If the production increase leans towards lighter crudes, we might see a more direct impact on gasoline prices. If heavier crudes dominate, the effect on different refined product markets could vary. Market analysts will be watching the composition of this increased supply to understand its precise impact on different segments of the oil market. Understanding these mechanics and underlying factors is key to assessing the true significance of OPEC Plus production decision. The market's response to the OPEC Plus production increase was immediate and decidedly bearish. Oil prices reacted sharply, accompanied by increased trading activity and ripple effects across related financial markets. Let's break down this granular market reaction. Brent crude oil futures witnessed significant intraday volatility upon the OPEC Plus announcement. Opening at $71.30 per barrel, prices quickly tumbled to an intraday low of $70.15 within hours. While a slight recovery occurred later, Brent closed at $70.60, a 1% daily drop and a 5-month low. WTI crude mirrored this pattern. This intraday price action clearly demonstrates the market's immediate negative assessment of the OPEC Plus news, with sellers dominating trading early in the day. Accompanying the price drop was a surge in trading volume for oil futures. Volumes jumped 30 to 40% above average, signaling heightened market activity. This spike reflects increased uncertainty, as traders adjusted positions, hedged risks, and engaged in speculative trading, amplifying the price movements. The bearish sentiment extended to equity and currency markets. Energy stocks globally faced downward pressure, with major companies experiencing share price declines of 1.5 to 3%, reflecting investor concerns about reduced future profitability at lower oil prices. Currencies of oil-exporting nations, including the Russian ruble and Saudi rial, weakened against the US dollar, as lower oil prices threaten export revenues and economic outlook. Market analysts point to several factors driving this bearish sentiment. Oversupply fears are now amplified, noted one analyst, highlighting the 2.2 million BPD increase against a backdrop of uncertain demand. Another expert suggested a strategic shift by OPEC Plus towards prioritizing market share over aggressive price support. Concerns about the global economic outlook and the potential demand-dampening effects of U.S. tariffs further contributed to negative market sentiment. Algorithmic trading likely amplified the price drop, with automated systems reacting instantly to the news and triggering sell orders. Analysis of futures contracts reveals that front-month contracts saw the steepest declines, indicating immediate oversupply concerns, while later-dated contracts also fell, but less dramatically, suggesting a near-term bearish bias in market expectations. The futures curve may flatten or show a slight contango, reflecting expectations of continued price pressure in the months ahead. In summary, the market reaction was decisively bearish, driven by oversupply fears, demand uncertainties, a perceived OPEC Plus strategic shift, and amplified by algorithmic trading, with clear impacts across oil prices, energy equities, and related currencies. The OPEC Plus production decision and its impact on oil prices extend far beyond simple economics. They trigger strategic shifts and have wide-ranging consequences across geopolitics, various economic sectors, the energy transition, and different regions of the world. OPEC Plus decisions are inherently geopolitical. The alliance itself is a strategic entity, navigating complex relationships between member states and global powers. Saudi Arabia's ties with the U.S. and Russia's with China are key factors. OPEC Plus must balance internal member interests with external pressures from major oil consumers. This production increase reflects this delicate geopolitical dance, seeking to address consumer nation concerns while maintaining long-term influence in the energy market. Economically, lower oil prices create ripples across sectors. Consumers benefit from cheaper fuel, boosting spending. transportation and manufacturing sectors see reduced operating costs. Agriculture benefits from lower fuel and fertilizer expenses. However, the renewable energy sector might face headwinds as cheaper oil reduces the immediate economic incentive for clean energy transitions, though long-term drivers for renewables remain strong. The energy transition and climate change goals are intricately linked to oil prices. Lower prices can paradoxically slow the shift to renewables by making fossil fuels more competitive. However, research suggests that the long-term shift to renewables is unlikely to be derailed by short-term oil price fluctuations. While cheaper oil might reduce immediate urgency, the fundamental drivers for energy transition, climate concerns, energy security, and technological advancements remain powerful. In fact, some analyses suggest lower oil prices could even indirectly help renewables by freeing up capital for investment in clean energy infrastructure. The relationship is complex and not simply a case of lower prices equals slower transition. Regionally, impacts vary. Developed economies might see a greater boost to consumer spending due to lower fuel costs. Developing economies, especially oil importers, could experience economic relief, but oil-exporting developing nations might face fiscal challenges. Trade tensions and global economic slowdown risks further complicate these regional impacts, creating uneven economic outcomes. National oil companies will adapt their strategies. Lower revenues may prompt cost-cutting and efficiency drives. Some NOCs might double down on oil production, while others could accelerate diversification into renewables and petrochemicals to ensure long-term sustainability. Their strategic choices will significantly shape the future energy landscape. The OPEC+ decision has cascading strategic and economic implications, impacting geopolitics, diverse sectors, the energy transition, regional economies, and the future strategies of major energy players. Understanding these multifaceted impacts is crucial for navigating the evolving energy world. In conclusion, the OPEC+ production increase is a significant event that sets the stage for a potentially volatile period in the oil market. While the stated aim is to balance supply and demand, the actual outcome will depend on a complex interplay of factors in the coming months and years. To navigate this uncertain energy future, let's consider three plausible scenarios that could unfold over the next 1 to 2 years. Scenario 1. The balanced market, stability prevails. In this scenario, global economic growth continues at a moderate pace, avoiding a sharp slowdown or recession. Oil demand grows steadily, albeit not explosively. OPEC+ effectively manages its production increase, demonstrating its flexible approach by adjusting output as needed to match demand. Geopolitical tensions remain contained, and no major unforeseen supply disruptions occur. Technological changes in the energy sector continue at a gradual pace, without causing immediate market upheaval. In this balanced scenario, we could see oil prices stabilize in a range of $65 to $75 per barrel. This would provide a degree of predictability for businesses and consumers, supporting moderate economic growth and allowing for a measured pace of energy transition. The energy industry would experience relative stability, with investments continuing in both traditional oil and gas and renewable energy sectors. Scenario 2. Demand slowdown, price weakness returns. This scenario envisions a less optimistic economic outlook. Persistent inflation, aggressive interest rate hikes by central banks, or escalating trade conflicts trigger a significant slowdown in global economic growth, potentially even a mild recession in some regions. Oil demand weakens more sharply than anticipated. Despite OPEC+'s production management efforts, the demand slowdown outpaces supply adjustments, leading to an oversupply situation and a buildup of oil inventories. In this scenario, oil prices could drift downwards, potentially falling below $60 per barrel and remaining under pressure for an extended period. This would benefit consumers through lower fuel costs but create significant financial strain for oil-producing nations, potentially leading to budget cuts and economic instability in those regions. The energy industry would face headwinds, with reduced profitability and potential cutbacks in investment, particularly in higher-cost oil projects. The renewable energy sector might see some relative boost in competitiveness due to lower fossil fuel prices, but overall investment across the energy spectrum could be dampened by the weaker economic climate. Scenario 3. Geopolitical spike, volatility and price surges. In this scenario, global economic growth remains moderately robust, but unforeseen geopolitical events inject significant volatility into the oil market. A major escalation of conflict in a key oil-producing region, a significant disruption to shipping lanes, or unexpected political instability in a large OPEC Plus member country could trigger a sudden and sharp reduction in oil supply. Even with OPEC Plus planned production increase, these geopolitical shocks could overwhelm supply adjustments, leading to rapid and substantial price spikes. Oil prices could surge to $80, $90, or even higher per barrel in this scenario, depending on the severity and duration of the disruption. This would exacerbate inflationary pressures globally, disrupt supply chains, and create significant economic uncertainty. Energy industries would face extreme volatility, with potential for windfall profits for some producers in the short term, but also increased risks and instability. The renewable energy sector could see a surge in interest and investment as nations seek to reduce their vulnerability to volatile fossil fuel markets. These three scenarios are just a few of the plausible paths forward, and the actual future will likely be a complex mix of these and other factors. The oil market is inherently dynamic and influenced by a multitude of variables, making precise predictions impossible. However, understanding these potential scenarios allows us to better anticipate the range of possible outcomes and prepare for different eventualities. We want to hear from you. Which of these scenarios do you find most likely, and why? What other factors do you believe will be most critical in shaping the future of oil prices and the global energy landscape? How should governments and businesses prepare for these different possibilities? Share your insights, predictions, and questions in the comments section below. Let's discuss the future of energy together. Don't forget to like this video and subscribe for more in-depth analysis. Thank you for watching.